in 2019, there was a repo spike, and the Fed was kind of shifting. They ended quantitative tightening in response to it. They started shifting to kind of gradual balance sheet increases. They didn't want to call it QE because they weren't doing it for economic stimulus and they weren't buying duration. They were only buying T-bills, and they were doing it primarily just to support bank liquidity. Now, and then of course, a few months later, when COVID and lockdowns hit, they went into like giga stimulus. But if you factor that out, that's basically that was kind of that liquidity thing that they were addressing. What we see here today is kind of a repeat of 2019. If there's a really big stimulus, we can call that the big print. Whereas my base case is more toward a gradual expansion of the balance sheet, which they won't call a stimulus. They won't say it's for economic stimulus. They'll say it's for financial plumbing and technical issues. But really, basically, it's to support ongoing fiscal deficits and bank lending without allowing any sort of contraction to occur.
Over the past few months, something subtle but incredibly important has happened inside the U.S. financial system, something most people missed entirely. On December 1st, without fanfare, without a press release, and without the usual media noise, the Federal Reserve quietly stopped quantitative tightening. According to Lyn Alden, this wasn't just a routine shift in policy. It was the return of a pattern that seasoned macro investors will recognize immediately: the transition from visible stimulus to silent liquidity support. Alden argues that what we're witnessing now looks strikingly similar to late 2019, a period when repo markets cracked, bank reserves dried up, and the Fed was forced to expand its balance sheet under the polite label of financial plumbing. Back then, the liquidity wave was masked by the chaos of COVID. But today, there's no global shutdown to blame, no war, no extraordinary emergency, just a system quietly hitting its limits. And this is where Alden's framework becomes critical. She believes we've entered a new phase, not a big print, where the Fed openly floods the system, but a gradual print, a stealth form of balance sheet expansion that grows in line with nominal GDP. It won't be marketed as stimulus. It won't be framed as helping households or supporting growth. Instead, it will be justified as maintaining liquidity, stabilizing repo markets, and keeping Treasury issuance from overwhelming the system. For informed investors, the implications are enormous. This shift suggests that U.S. policymakers may be navigating an economy that is far more fragile than headlines suggest. An economy powered by fiscal transfers and AI capex at the top, while the broader base of consumers and businesses quietly strains under tightened monetary conditions. And if Alden is right, this is the moment where temporary crisis tools become permanent structural features. In this video, we break down Alden's full analysis, from the soft landing debate to the emerging market dynamics shaping U.S. growth, to the long-term consequences of the Fed's return to gradual expansion. And more importantly, we discuss what this means for crypto investors' positioning ahead of 2026. If you enjoy deep dives like this, please watch the video to the end, like this video, and subscribe to the channel for more insightful analysis. Thanks for the support, and enjoy the video.
Explain where we're at in this moment. Is it a soft landing or is it just a mask?
So I think it's a little bit of both. I think as you described it, there's a narrowing. So the two main drivers holding up GDP growth are, one, the fiscal transfers. So we still are running above target, fiscal deficits as a percentage of GDP, and those are going to a segment of the economy. And then, of course, AI capex. And so any investment or trend that's generally on the right side of those forces is generally in pretty good shape. And a broader set of entities that are not really on the right side of those are suffering. They're dealing with tighter monetary policy, and they're not really getting the benefit of either AI spending or the fiscal transfers. So we have a narrowing of the economy. And as I kind of point out in my recent report, this is in some sense what you see in emerging markets. It's a little bit more stagflationary. It's a little bit different than a normal slowing economy that we see in developed markets, because it's still coming with above target debasement, largely driven by that fiscal excess. And so it's more stagflationary rather than kind of the disinflation that we normally see during kind of weaker economic periods.
I mean, even if manufacturing is weaker, they'd say that the strength in service keeps the U.S. out of recession. Does that argument carry weight?
To some extent. I mean, that's why I'm not too bearish, because you have to ask, what else would you be long? Is
Yeah.
it cash and bonds? Certainly around the margins, that can be useful for sell-offs, for volatility reduction. And I am more nervous around equities here than I was, a year or two ago. But that's kind of been my trend for a while. That there's multiple things to truly be bearish about, but you still generally want to be long scarcer things compared to abundant things. And it is true that the top segment of society is responsible for a lot of the spending. They hold a lot of the assets. And so I generally describe the current macro environment as more of a social issue than a macro issue, meaning that there's political ramifications from the level of frustration that exists throughout the economy. But that's different from something that could kind of heavily sink stocks. Right now we see pretty much record divergence between near all-time high stock prices and near all-time low consumer sentiment going back many, many decades. The only other time we were in this kind of position was the really early 80s. When stocks were recovering and sentiment was still very low in a recession. So this is quite an unusual period, especially outside of recession. It's pretty much unprecedented. And so you see that narrowing effect, which is real, but it doesn't necessarily mean you want to short it. That's exactly what happened. They had been sucking liquidity out of the system. The combination of the Treasury general account filling a little bit above target because of the shutdown, combined with the fact that just there's kind of pockets where liquidity is and where it isn't. The Fed had to intervene with their standing repo facility. Now, to some extent, this was anticipated by the Fed about 2 years ago. They published annual reports where they kind of project what their balance sheet's going to look like. And they're basically saying by around 2026, they're likely going to end balance sheet reduction and go back to gradual balance sheet expansion that's roughly in line with nominal GDP growth. Now, I think overall this hit probably a few months early, partially because of that Treasury General Account issue. But it's really not that different from what they expected. So they've already had, a period of time of gradually tapering the rate of their balance sheet reduction. Now that they have this acute liquidity stress kind of tapping them on the shoulder, they've all out ended the balance sheet reduction. There are some talks about balance sheet expansion. That's still probably a little bit premature, but I think we'll probably see that in 2026. And again, it'll be in line with gradual GDP growth, most likely. It won't be some massive fiscal stimulus, or I should say a monetary stimulus. Instead, it'll be this like gradual liquidity surplus added to kind of keep the wheels on. Because as you say, the treasury market pretty much needs that to function. The repo market needs that to function. Now, technically, there's other levers they can pull. They can, for example, ease the supplementary leverage ratio for large banks, which would effectively allow them to absorb more treasuries and to be able to perform more repo activities without running into certain thresholds. But that's something that the Fed will have to look at, probably next year.
Yeah.
So before 2008, they had a structurally rising balance sheet already. The monetary base was structurally rising. That's how fiat system works. It's different from gold in that regard. Now, of course, the difference here is that they now with kind of post GFC regulations, banks run with much higher cash levels. And so the Fed's balance sheet is a bigger share of the GDP, but it does make sense that they're going to go back to gradually expanding that balance sheet, but from a higher layer. And this is one of the foundations of debasement. If in theory you had a fixed monetary base, that's what the Fed controls, the monetary base. If you had a fixed monetary base and banks make all these IOUs on top of it, whenever they run into problems, their number of IOUs would collapse, closer to the base amount. And people would risk losing deposits in their bank, and the banks, of course, would be at risk. And instead, the way that they operate the system is whenever they run into that issue, they instead increase the monetary base to keep most of those IOUs money good. And that's
Right.
basically the difference between, say, a kind of a hard money gold system versus the fiat world we live in.
If liquidity expands only gradually, does the cap, does that cap the upside for financial assets? I mean, what are we looking at in 2026? Is it going to be kind of a melt up narrative investors want to believe, or do you think it's a slow grind?
Well, sentiment can dictate how fast asset prices move, because asset prices, of course, can move quite differently than
Yeah.
underlying liquidity conditions. But generally speaking, yeah, that should, the bias is toward kind of a gradual increase. Yeah, and for context, in 2019, there was a repo spike, and the Fed was kind of shifting. They ended quantitative tightening in response to it. They started shifting to kind of gradual balance sheet increases. They didn't want to call it QE because they weren't doing it for economic stimulus and they weren't buying duration. They were only buying T-bills, and they were doing it primarily just to support bank liquidity. Now, and then of course, a few months later, when COVID and lockdowns hit, they went into like giga stimulus. But if you factor that out, that's basically that was kind of that liquidity thing that they were addressing. What we see here today is kind of a repeat of 2019, except hopefully without this kind of big lockdown or pandemic or war or whatever in front of us. So if you just have that environment, you're more likely looking at this kind of more gradual scenario. And yeah, the gradual print. I mean, the term there is so. I was on Natalie Brunell's show and I talked about this kind of gradual expectation we were going to see. Of course, my friend Larry Lepard has a book out called The Big Print, and so we're on somewhat different sides of how much balance sheet expansion we expect next year. If there's a really big stimulus, we can call that the big print. Whereas my base case is more toward a gradual expansion of the balance sheet, which they won't call a stimulus. They won't say it's for economic stimulus. They'll say it's for financial plumbing and technical issues. But really, basically, it's to support ongoing fiscal deficits and bank lending without allowing any sort of contraction to occur. So when they run into fiscal dominance, their choices essentially are either let inflation run hot or let the sovereign bond market potentially default and run into liquidity problems. That's really their two main choices. Like I mentioned, the third choice, which only works temporarily, is they could ease regulations on banks so they don't have to count treasuries and cash against their capital, which basically allows banks to lever up and buy more treasuries or perform more repo lending. So they have a handful of levers they can pull that either look like QE or shadow QE. But at the end of the day, they never let the bond market just go illiquid, and so they always err on more inflation, even when it's above target.
Alden argues that this shift toward gradual print has massive implications for Bitcoin and the broader crypto market, and she's not exaggerating. Over the past few weeks, BTC's price action has already reflected a market sensing that the liquidity cycle is turning. After months of choppy correlation-heavy trading, Bitcoin has begun to decouple from risk equities, showing stronger upside momentum on liquidity-driven narratives. According to Alden, this isn't random volatility. It's the early reaction to a Federal Reserve that has quietly stopped tightening while fiscal deficits continue to expand. In her framework, Bitcoin performs best when monetary policy enters these stalling phases because liquidity injections tend to arrive indirectly, without the Fed explicitly announcing a pivot. And this is where Alden becomes very clear. If the Fed has entered a long-term environment where balance sheet expansion grows alongside nominal GDP, crypto is positioned to benefit in a way traditional assets cannot. Every period of stealth liquidity expansion in the past, late 2019, mid-2020, late 2022, coincided with aggressive repricing in crypto. Alden believes the 2026 cycle could be even more dramatic, not because of hype, but because monetary conditions and structural deficits leave policymakers with fewer tools and fewer exits. For Bitcoin, she sees this as a recipe for persistent upward repricing. For altcoins, she sees selective winners tied to real use cases, but fewer broad-based rallies. According to Alden, the next bull market won't be driven by sentiment. It will be driven by math.
Well, Bitcoin's always like more volatile than people expect. I mean, I would have liked to have seen 150K this year. We only got to 126K, which is not too far off, but it's a little bit on the disappointing side. In general, I think there is a little bit of treasury, like those treasury companies. Some of their MNAVs, their market value to net asset value, got a little bit excessive. We also started to see altcoin treasuries, which I don't think was a particularly healthy development. So I think it's natural for a lot of that space to get washed out, even though some of the leading ones I think are healthy overall. They have pretty low debt to Bitcoin ratios. So I think as we see that right size, as we see some selling, I also think there's kind of a self-fulfilling prophecy. So Bitcoin hit a multi-year peak in Q4 of 2013. Then it hit another major peak in Q4 of 2017. Then yet another major peak in Q4 of 2021. Basically, it's kind of in line with Bitcoin's kind of 4-year supply halving cycle. So I think investors are spooked that if it didn't reach their targets here in Q4 2025, that they might have to wait multiple years for their next run. That's where I would generally disagree, and I think that we're no longer on a 4-year clock. So I think there's some selling that basically fear that we are. but there's no particular kind of supporting reason that cycle would still be in effect. So I do think that in the next couple of years, I think Bitcoin is still well positioned, and right now, basically, a lot of the leverage and sentiment has been washed out of it.
Yeah, you brought up strategy. I have to ask you. I mean, it's kind of the elephant in the room. Is the market kind of finally just repricing the idea that a corporate balance sheet can function as a Bitcoin hedge fund?
Well, I think they're repricing it. I mean, I don't think that the 3 times MNAV it was trading at was sustainable. I mean,
Yeah.
there were other ones trading at even higher MNAVs, like Metaplanet was at something like an 8 times MNAV back in June. I don't think those levels are sustainable. I do think that Bitcoin with non-callable leverage attached to it, the type that corporations can issue, is pretty attractive and can warrant an MNAV above one. But there's a kind of a range that makes sense, and I think that a 3 times MNAV doesn't really make sense. So there's been a repricing. And I still think the business case itself makes sense. I would like to see more of these treasury companies have cash flows to support their interest expense. But when you look at how most of them are structured, the top ones like Strategy or Metaplanet, they've got pretty low debt relative to their assets. During the bull market, MicroStrategy has something like 20% debt and preferreds as a percentage of its Bitcoin. Now it's a little bit higher because Bitcoin's gone down, but
Yeah.
even their preferreds are not, exactly debt,
Yeah.
and so the actual debt portion is still quite a low percentage of their Bitcoin holdings. So it's fairly conservative leveraged, but it does make sense that investors would be spooked when they're holding it at 3 times MNAV or even when it back down to 2 times MNAV, that they'd want to kind of right size that position. So I think we've seen kind of this over euphoria in the space. I think there's going to be there's an ongoing washout of the weaker ones, the ones that were kind of poorly capitalized or poorly run, or bet on the wrong asset. But I think as it kind of washes out, I do think that a handful still makes sense as long as they're conservatively run. And of course the differentiation that they have compared to ETFs is that if an investor is bullish, they can buy unlevered Bitcoin, which I think makes the most sense. You generally want to have your core position be unlevered. Ideally, you can buy it and take it into self custody, but if you're the type of investor that's going through a brokerage account, the ETFs are very useful. But then for bulls that want a little bit more leverage, it's still conservative leverage, but it's some leverage, and so it is a differentiated security than you get from an ETF or from owning the underlying itself.
Are you saying that the high utility is actually kind of bearish for a token, that these networks will be very useful to society, but terrible long-term investments?
Pretty much, I basically would say that puts them in the category that look more like equities. From the beginning, I've been bullish on Bitcoin and I've been bullish on the growth of stablecoins. But that bullishness doesn't really extend to other cryptos. That doesn't mean that there's still not some that are useful. I mean, obviously, there's some things serving as the tech rails for the stablecoins and other types of assets. But that my argument is that the overall market value of those is unlikely to grow very large. As evidence of that, I mean, if you look at the ETF industry, there's over 13 trillion of ETF assets that are, basically a handful of companies issue the majority of them, and those companies are worth less than $200 billion. It doesn't take a lot of kind of operations to run this really big platform, and the same thing's true for the big stock exchanges in the world. The company, the two companies, New York Stock Exchange and Nasdaq, that are responsible for the vast majority of U.S. market cap, tens of trillions of dollars. To collectively, they're worth less than like half of Ethereum. And so when people look at these crypto assets and they say, well, this is going to serve as the tech rails for billions or trillions of dollars of stable coins and trillions of dollars of tokenized, whether it's real estate or art or equities or whatever you have it, the numbers that they have to reach in order to make these things worth what they already are worth are extraordinarily high. If you look at them on any sort of revenue basis and kind of treat them as though they're a tech equity.
Yeah.
Basically, there's a lot of competition between utility protocols. I think you price them like those tech rails, and the only one that I think is basically worth being a multi-trillion-dollar asset is potentially Bitcoin, because that's the one that's bought for its own sake. It's bought because people want to hold Bitcoin. They want the leading network effect and security for portable capital. So that can potentially warrant it as long as it remains decentralized and secure, and kind of the best at what it does. But outside of that, I think the valuations are quite high.
When you compare Alden's macro framework with Raoul Pal's, The overlap is impossible to ignore. Alden approaches the issue from the balance sheet side. Powell approaches it from the liquidity side. But both arrive at the same conclusion. The U.S. financial system cannot afford a hard landing, and the Federal Reserve will be forced into a long-term liquidity expansion, whether it publicly acknowledges it or not. Powell has been blunt. Deficits are too large, Treasury issuance is too heavy, and the political cost of a recession heading into the Trump presidency is simply too high. In his view, the Fed will keep easing subtly throughout 2025, and the moment President Donald Trump replaces Jerome Powell, a scenario Powell sees as extremely likely, the Fed's stance will shift even more aggressively toward liquidity support. And whenever liquidity expands, he argues, crypto is the fastest horse in the race. Alden agrees with the destination even if she frames it more cautiously. She sees a slow, grinding shift into permanent liquidity, a world where the Fed expands its balance sheet, not because it wants to, but because the system demands it. Powell sees the same outcome, but expects the political cycle to accelerate it. And they both highlight that crypto is uniquely positioned because it thrives when real rates fall, liquidity rises, and trust in traditional monetary tools weakens. If Alden is right, 2026 becomes the year where Bitcoin fully transitions from a speculative asset to a structural hedge. If Powell is right, it becomes the year when liquidity floods back into the system in full force, driving an aggressive repricing across the entire crypto complex. Either way, crypto investors are heading into one of the most consequential macro environments in modern financial history. And tell us in the comments, which scenario do you think plays out first? Alden's gradual print or Powell's full liquidity pivot? If you want to stay ahead of these macro shifts and understand how experts like Alden and Powell see the next crypto cycle unfolding, make sure to like this video, subscribe to the channel, thanks for watching, and see you in the next one.